Welcome to this explainer. Look, if you've ever felt like investing in the stock market, specifically on the Lusaka Securities Exchange, or LUS, is just a giant, intimidating guessing game, you are absolutely in the right place. Today, we're taking that guesswork and transforming it into a clear, completely measurable skill. If you're a beginner who has literally never heard of a financial metric before, stick with me. We are going to build this from the ground up. Let's start with a story that, honestly, you might find all too familiar. This is about a university student named Chanda. Now, Chanda had painstakingly saved up K3000 from working over the holidays. One day, his roommate tells him that a company called CEC is definitely going up because, well, it was just in the news. Based purely on that friend's tip, Chanda goes out, opens a stockbroking account, and buys 200 shares. 3 weeks later, bam, the share price dropped a painful 7%. He felt completely lost. But then he realized something absolutely crucial. He needed a reliable framework, not just casual tips from his buddies. Okay, let's dive into this. Here is our roadmap for today. First up, the problem with guesswork. Then, what are you actually buying? After that, we'll look at 2 ways to pick stocks before jumping into the main event, the 5-metric scorecard. We'll wrap up with the golden rule of diversification and exactly where to find all this data. Section 1. The problem with guesswork. Basically, don't fly blind. Here's the thing. Most first-time investors in Zambia, they buy shares based on news snippets, rumors, or just because a company name sounds familiar. They never actually look at the underlying data. And guys, that is a massive mistake. After Chanda's investment tanked, he went looking for answers and, quite easily, found CEC's annual report right there on the LUS website. The realization hit him like a ton of bricks. The information had always been there, he just hadn't known what to do with it. These financial reports are completely public, and this explainer is going to teach you exactly how to interpret those numbers so you never ever fly blind again. Section 2. What are you buying? Let's understand shares. Before we even touch the math, we really need to define what it actually means to own a piece of a publicly traded company. When you invest, you're generally looking at 2 main categories of shares. First, you have ordinary shares. These give you an actual ownership stake, meaning you get voting power at shareholder meetings and you ride the wave of the company's growth through variable dividends. Then, on the flip side, you have preference shares. These act a bit more like a predictable debt instrument. They give you priority for fixed dividends and a higher claim on assets if things go sideways and the company goes bankrupt. But usually, you don't get voting rights and you kind of miss out on that massive explosive growth. Section 3. 2 ways to pick stocks. Top-down versus bottom-up. So, how do professional investors figure out where to look before they even calculate the math? Broadly speaking, there are 2 main strategies. First is the top-down approach. This starts by analyzing the big picture, macroeconomic indicators like inflation and interest rates, before narrowing down to specific sectors that are doing well in that environment. Conversely, the bottom-up approach ignores the big picture at first. It focuses purely on analyzing individual company fundamentals, searching for strong earnings and rock-solid business models. While some folks look at the whole economy first, we are going to focus heavily on the bottom-up approach today to analyze specific businesses. Section 4. The 5-metric scorecard. Time to measure stock value. So the crucial point is, if you can calculate specific metrics, they will reveal a stock's true underlying value. Think of it like a tape measure. Just like a tape measure gives you the objective dimensions of a physical object, our 5-metric scorecard gives you an objective measure of a company's financial health. It takes the emotion, the rumors, and the guesswork completely out of the equation. Let's break down these 5 metrics, one by one. Metric number 1 is the PE ratio, or price to earnings. I want you to think of this as paying for profit. It tells you exactly how much you are paying for every single kwacha of profit the company makes. You calculate it simply by dividing the market price per share by the earnings per share. To put that into perspective for the LUS, a PE between 8 and 15 is pretty common for a stable, profitable business. If the PE is way higher than that, well, either the market expects massive future growth or the stock is just straight up overpriced. Metric 2 is EPS, or earnings per share. This is essentially the company's paycheck per share. It's the net profit divided by the total number of shares outstanding. Let's do some quick math to make this concrete. If Zambia Sigur reports, say, K450 million in profit across 500 million shares, that equals a 90 ngwee paycheck for every single share you hold.
When you're looking at historical data, a rising EPS year on year is hands down the clearest sign of a healthy, growing business.
Metric 3 is the dividend yield. Think of this as your cashback reward. It's calculated as the annual dividend per share divided by the share price. Now, what's really interesting about this metric is that an unusually high yield isn't always a good thing. Sure, dividends are fantastic income, but if you see a yield shooting above 8 or 10%, it might actually mean the share price has recently crashed. That makes an old dividend look deceptively large compared to the new, low share price. Always check if a dividend is actually sustainable. Metric 4 is year-on-year revenue growth. This tells you if the business has actual commercial momentum. But a vital adjustment is required here. You absolutely must compare revenue growth to Zambia's inflation rate to see if you have real growth. For instance, .com Zambia recently saw an explosive and frankly unbelievable 147% revenue surge thanks to some public sector digital contracts. Now, that is exceptional momentum. It far outpaces inflation and signals a business in serious structural growth. Metric 5 is the net profit margin. Simply put, this measures how much of the money the company actually keeps. You find this by dividing the net profit after tax by the revenue. And this brilliantly illustrates a massive concept. Massive revenue absolutely does not guarantee huge profits. For example, Zambia Sugar historically runs with very healthy margins, around 12 to 18%. Contrast that with .com Zambia. Even with that insane 147% revenue growth we just talked about, their profit margin was a razor-thin 0.66%. Now that's kind of typical for an early-stage tech company that's aggressively investing in growth, but it represents a totally different risk profile. To pull the whole shebang together, here is your mental cheat sheet. Notice how combining these metrics instantly reveals the health of a stock. A P ratio between 8 and 18, that's a green signal. But under 5, or if they're reporting a loss, definite red flag. A rising EPS trend is green, declining is red. A consistent dividend yield of 3 to 7% is a green light, but a high yield over 8% is a yellow light, meaning, hey, you need to investigate that. Seriously, feel free to take a screenshot of this right now. It is going to be your ultimate reference guide. Section 5, the golden rule, diversification. This is your safety net. Let's move on and see how this builds from finding just one good stock to protecting your entire financial portfolio. Diversification is your ultimate safety net. You really want to aim to spread your investments across 15 to 30 companies operating in entirely different sectors. Doing this dramatically reduces your industry-specific risk. It ensures that if you make one bad bet, it doesn't wipe out your hard-earned wealth. Plus, it balances your returns across different economic cycles, whether we're booming, stagnating, or dealing with high inflation. Section 6, finding the data. Where to get your free, loose data. Okay, so you have the scorecard in your head now, but where on earth do the raw numbers come from? I want to empower you right now by revealing exactly where you can find all this information for any listed company. And the best part, it is entirely free. Here is a super concrete, actionable 3-step process. Step 1, find the current live share price and trading volume over at fx.coec.org. Step 2, head over to loose.co.cm, navigate to the SENS announcements under listed companies, and download the latest annual report. Step 3, crack open the income statement inside that report, grab your revenue and net profit numbers, and calculate those 5 metrics. Which brings us to our final and most critical thought. What are you going to do next? Will you keep treating the stock market as a game of chance, relying on whispers and hoping for the best like Chanda did? Or will you treat it as a real, measurable skill? I challenge you to ditch the rumors, go download an annual report from the Loose today, and run this 5-metric scorecard for yourself. Thank you so much for joining me for this explainer. Keep analyzing, stay curious, and I'll see you next time.